in terms of this conversation and on my particular angle, Gary, that's probably my kind of, cry for, hopefully somebody's listening in influential circles who gets it, that this is not about throwing away taxpayer money. This is about investing taxpayer money that will pay back in just multitudes if it's done in the right way.
Hey everybody, I'm Gary Fox and this is the Entrepreneur Experiment podcast. Welcome. So each week I sit down and chat to an experienced entrepreneur and hear their story. But this week we're flipping things around. We're looking at it from the investor's point of view. So we're looking at what makes an entrepreneur very investable. But first, quick note on the book club. We're running the book club for June. This month's book is Never Split the Difference by Chris Voss. It's about negotiation, sales, and most importantly, communication. I'm about halfway through already, and it's a brilliant book. Very, very practical. So we're going to read that for the month of June. You can go visit my website and register for the book club. We'll be doing a special podcast and live webinar at the end of the month. So go to the website and register for that. Back to today's guest, Alan Merriman. Runs a multifamily office. I wasn't very sure what that was before we actually started chatting. So we explain what that is. And we specifically talk about venture and venture investing. Alan has been behind some of the most prominent investments. The name will probably ring a bell for you. Alan's name and Elkstone will probably ring a bell for you because they've been in the news quite a bit recently due to the success of some of their investments, and some of the companies they're involved in have raised significantly high amounts of money, including Let's Get Checked, which is most prominently in the news for their COVID testing, and also raising $71 million in the last couple of weeks. So we chat about that, and I talk about it very much from an entrepreneur's perspective. Alan is an entrepreneur at heart, and he gives very practical advice to entrepreneurs as to what he looks for. So when you get in front of him and you're pitching your company to him, he tells me exactly what he's looking for, and also, most importantly, what he's not looking for. So it's a really good, practical episode. You'll notice I'm switching content up in the last couple of weeks. I'm trying to lean towards very practical content that can help people in this challenging time. If you have any feedback or any episodes you'd love me to cover, get in touch. All the usual social channels are open. So here we go. This week's episode with Alan Merriman from Elkstone. Alan, welcome to the pod.
Yeah, great, Gary. Thanks for having me.
Absolutely delighted. You've taken time out on one of probably the hottest day of the year to come inside.
Well, look, I think I can afford an hour, no bother.
So thanks a lot. So listen, ask everyone just kind of give a quick intro to themselves, that horrible intro question everyone asks, just kind of a quick overview of who you are and what you do.
So I'm one of the founders in Elkstone. Elkstone, the multifamily office. We're involved in a lot of things, including venture and wealth management and real estate. My own background, I've had quite a few chapters, but going back in time, I was a partner in PwC. I ran their financial services practice. Then I was at EBS, the Building Society. I was the finance director there. Then I worked for a corporate finance boutique, which was bringing together sovereign wealth funds and S&P 500 type companies. I was there for a couple of years doing private equity, amongst other things. And then I ended up starting Elkstone for a former boss of mine as a single family office, and then grew that into a multifamily office. So that's the very short story.
That's a really succinct. You've done that once or twice. Actually, there's the first question. What is a multifamily office? What is a single family office, multifamily office? What is that? I think people in Ireland might be very familiar with it.
Yeah, I think that's fair. I think family offices really haven't existed in Ireland, very few of them anyway, and certainly practically rare on our own as a multifamily office. So single family office is a professional group of people who are working for a single owner, looking after their wealth management. And that can be looking after their equity portfolio. It can be helping them with their own business. It can be helping the wider family, etc., etc. A multifamily office is broadly the same, except you're doing it for a multitude of families and or individuals. And the whole idea behind the multifamily office is that you're sharing the cost base so you can reinvest, you can have a deeper team, you can have broader expertise, and you can have synergies between the different families or different entrepreneurs. So, a lot of cross-sharing of deals and so forth. So that's the idea behind a multifamily office, a kind of deep professional expertise shared across lots and lots of investors as distinct to just one family.
And why is it pretty rare here? I think, people might be hearing this for the very first time. I think a lot of entrepreneurs listening will be very familiar with you and your profile with Elkstone, but a lot of people might be. So why are family offices still pretty rare here?
I think it goes back to just the Ireland Inc. and, how we as a country have grown up, and we just haven't had the deep pockets in the past. We haven't had those, industrial type families and generational type wealth. So there just isn't a history. It goes back to America and the Rockefellers and JP Morgan and so forth, with the start of, substantial family offices. And we just don't have a history here. So it's very, very recent. And as I said, really, there's less than a handful of multifamily offices in Ireland, probably not even a handful. So, we're hoping we're at the start of what will be very much a growing trend, because we think there's a huge gap in the Irish market, and there's a real need for more sophisticated wealth management, and certainly a greater need for hand-to-hand service for entrepreneurs and how they're helping themselves leverage and manage their day-to-day affairs.
And how would you venture, or how would your company be different to, say, a venture capital fund? I think people might be more familiar with them and can understand them a little bit better.
I guess, well, look, we do a multitude of things. So clearly venture is just one asset class for us. So we do four things really. At the hub, it is this family office. So we're hand-holding and working hand in glove with our clients on whatever they need us to help them with. So overall asset allocation, risk management, reviewing their existing portfolios, helping them screen individual private equity deals, etc., etc. So that's the hub of what we do. And then Elkstone has really three specialist areas. One is the venture. So we act like a VC, but we're a family office, so we have a different DNA. We do a lot of real estate as a specialism, both lending and real estate projects. And then separately, we have an alternatives business, which is, effectively lending and other non-correlated assets where we try and bring a bit of value. So we're very different to a venture capital firm, in that a venture capital firm is typically doing one thing. They're very focused on their venture business and they're a fund, while we're a multi-asset manager, and we do lots of things, but a specialism of ours is the venture side. And we have a deal-by-deal approach. So we don't act like a fund, we act as a collection of clients investing in a single opportunity. So that makes us quite different. We're also different in that the network we have is with other families and other entrepreneurs, both within Ireland and across the globe. So we have a different type of network, we have a different type of ecosystem, and we can bring influence and help in different ways to how a VC. So it's not an either or. I think we're very much complementary, and that's the way we'd like to see ourselves.
And where did it all come from? Where did Elkstone start?
By accident, really. And so,
that's already going to be a good story.
Yeah, well, no, but definitely by accident. So my own history was I was in PwC. I'd been very lucky. I'd been very fortunate in PwC. I was a partner, ran the financial services practice. I was the lead partner on PwC's largest client, which was Bank of Ireland. Very young. I was 35, 36 years of age. I'd been a partner for 5 years and I was very happy there. And out of the blue, I got headhunted to go to EBS Building Society. Kept on saying no, genuinely kept on saying no. I didn't want to leave PwC. And they eventually convinced me. And I think they convinced me ultimately because at the time I did genuinely kind of fancy myself. I thought I was really good. I was conscious though that auditing and consulting wasn't the real world, that it was, you were somewhat protected. It was somewhat artificial. Would I be any good in the real world? And it's not that EBS was, a massive step into the real world, because it was a mutual and it was a different type of animal. But for me, it was go and test myself in the real world and see could I make it. So ultimately, that's why I left. I also left because I knew at 35, 36 years of age, and I think there's probably a connection back to my own view of myself as a risk taker. I'm fairly conscious if I didn't leave then, I was never going to leave PwC. I mean, it's very rare even today for partners to leave a big four accounting firm or a big five law firm. And, it was certainly very unusual when I did it. But I did it for what I felt were all the right reasons at the time, be it that I was very happy there. So I went to EBS, got my timing horribly wrong, joined in July 2005. So
I was going to ask you when this was, because that defines the next couple of years.
So, we'll come back to, how important timing is in venture, but timing is very important in all walks of life. So my timing into EBS was, certainly from in terms of what EBS was going to be grappling with over the following 2 to 3 years was terrible timing. But it was actually, for me narrowly, it was actually very good timing, because I got tremendous exposure, learned a huge amount, had to juggle a lot, very stressful circumstances, and ultimately ended up leaving myself in March 2009. EBS very much put its hands up in terms of saying, look, we were in things we shouldn't have been in. We got things wrong. We wanted to show accountability. And myself and the chairman resigned together to very much distinguish EBS from other players in the market at that point in time.
Wow.
And give EBS every chance of having what I might call the support of the government and Department of Finance to land on its feet, which happily did, as you know, with the acquisition from AIB. But I kind of left at a time where I wasn't sure what would be my next step, wasn't sure whether I was going to be tainted or not by what had happened. Luckily, the reputation seemed to hold up well. I got quite a lot of approaches pretty quickly. And I ended up, just for a very short period of time, going to Sean Riley of McGarrett Riley in a role to help him further professionalise. He had a very successful business, but to help him further professionalise. And I'd only started with Sean when I got a knock on the door to say, look, Alan, there's just going to be an amazing opportunity, best job in Ireland. You have to go for it. This was from a good pal of mine who was in the recruitment business. And I had to explain to him I had taken a job. And he said, no, Alan, look, this is the best job in Ireland. You're going to regret this for the rest of your life if you don't take it. If you don't at least meet the guy. So I was persuaded reluctantly to meet a guy called Roger Jenkins. Roger had been the kind of star banker from Barclays Capital. He was setting up a business in Ireland to connect together sovereign wealth funds and S&P 500 companies. And he'd only just set up and kind of discovered that he needed, some professional, CEO, COO in the Irish business, which was going to be the headquarters. So I met him. We very much clicked immediately. He liked my background, liked my versatility, given the PwC experience, liked the fact that I understood banking. And I joined, and I was very, very fortunate again that, in going back to Sean Riley to explain 6 weeks in that here I was, having been very grateful for the opportunity to have a new start. I was walking out.
How did that conversation go?
He was brilliant, really, really brilliant. He took it incredibly well. He asked me to stay on as a non-executive, which I did. Worked with Sean through the NAMA process with him. He and I are still very good friends today. We've done quite a bit of business together. And he and Roger actually agreed that they would share me for a while to allow that transition. So for me, it turned out to be, could have turned out very differently. Sean could have been really, really irked, but he wasn't. So that was a very nice bridge in terms of, what was a difficult year for me in terms of early 2009 started very, very challenging circumstances. And 2009 ended very well in that I was working for both McGarrett Riley and Sean and for Roger Jenkins and his business. And his business, confusingly initially was called SHS Capital, and then we renamed it to Elkstone. And then to jump forward, I had a great time with that business for 2 years, bringing together, lots and lots of global opportunities that I hadn't, certainly had been out of my league prior to there. But, so for example, I did 5 or 6 private equity deals, in Latin America, was involved in raising $1.5 billion for a Latin American investment bank called BTG Pactual. So it was a different world and a different experience. And towards the end of that period, and I was the COO for Roger in his business here in Ireland. And towards the end of that period, he got courted by BTG Pactual to join them as a managing partner. They were about to do an IPO and they wanted, somebody of Roger's caliber to help prepare for the IPO. He wanted me to go with him. I didn't want to go. I didn't want to leave Ireland. It was still a difficult period. This was, early 2011. He then tried to get me to go to London. I wouldn't go to London for BTG Pactual. And then he came up with the idea, look, Alan, why don't you, you don't know what you're going to do. Ireland's still in a difficult place. Why don't you look after me? Look after me for a year. Allow me to get a fast start in BTG. Run my investment world for me. I've been doing a bit of that in his business. I'd done a little bit of investment management in EBS because Treasury reported into me, but I wasn't a real investment manager. But I'd always dabbled in stocks and shares and things like that. So I did very well. So I agreed to do it for a year. It was a gentleman's agreement, do it for a year. If the super opportunity comes in Dublin, I'd leave to take it. He'd understand it.
Okay.
I had a young family, wanted to stay in Ireland, blah, 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 etc. So we agreed to do it for a year. And again, very lucky, had a very, very good first year, had a very, very strong investment performance. Got to the end of that first year, he was very keen I stay on. I was less keen because I still was waiting for, the proper opportunity.
So Elkstone was just, you're managing his money at this stage. That's what Elkstone was.
Yeah, managing his money. So he was a very wealthy guy. He was a guy who, again, public record in the UK. I think his top earning year had been 50 million sterling in a single year. He's the guy who was credited with saving the Barclays from the UK government scheme. He's had quite a few interesting chapters himself, those who know him. But when I first met him, I hadn't met him ever before, didn't know his history. Probably without any exaggeration, smartest guy I've ever met, and phenomenally bright guy.
Wow.
He set up things like iShares, to give it a context. So really, really clever guy. But anyway, I did that for a year, managing his money, came to the end. He was very keen I stay on. I was less keen. And through the jigs and reels, I came up with the idea of, look, I'll do it, but only if I set up my own business, only if I build out a multi-family office, because I don't want to work for one single individual. Didn't think he'd do it because he's very demanding and he's a 24/7 type guy, and he lives amongst the kings. But he agreed, and that was the start of my business. And for convenience and just to keep a veneer with the outside world, my own network, rather than have to go and explain I was changing role again, I called the business Elkstone Capital International Services. So I just carried on as if it was the same business, but it was now my business called Elkstone Capital International. And then, Roger was very good to me. He introduced me to a second client. They agreed and I agreed with them. It was a young woman. She just had a huge liquidity event selling a sports business, and she'd no infrastructure. So I met her. We agreed to do a pilot of 3 months, see how we'd get on together, because it's a very personal relationship. And, that went very well. And 3 months later, she was saying, look, Alan, can we make this a permanent deal? And then that's how the business grew. It grew from one client to the next client, word of mouth. I was very lucky. All my clients were international. The first 10 or 11 type clients I had were all individuals from different geographies out there in the big bad world. And I had this team in Dublin and we kept on reinvesting in the team. So I didn't take out any profits. I just rolled the money back into the company, kept on acquiring talent. And we built up to, a very nice team based in Dublin doing very interesting international activity, looking after international clients with no Irish clients. And that's why I say the business kind of happened by accident.
That was going to be one of my first questions for you is how did it have such an international focus from the start? Because even when you look at your portfolio now, it's a huge international focus. So you've kind of answered that question ahead. So Roger stayed with you and then you built kind of on referral, I suppose, on word of mouth.
Yeah. And then eventually, I don't know when, but, ultimately Roger and ourselves did part ways. He was based in Santa Monica. I was based in Dublin. He was very trading focused. I began to take a much greater interest in what I might call venture and other aspects of the business. So it just wasn't sustainable for him. And we went our separate ways. So we're still close, but he's not involved in the business in any way.
Okay.
And, I came to a difficult decision about 4 or 5 years ago where, Elkstone had done very well. I'd done very well, but I was very conscious I had a very talented team around me. But I was very much the bottleneck. So I was conscious that I really wanted to build an interesting, what I would consider an interesting business. I was the bottleneck and it wasn't really sustainable. I was also, I'd become the 24/7 man and I was on the plane all the time and so forth. So I made a very conscious decision that, I've been very lucky. I have a real opportunity at my own doorstep here. Really there's a gap in the market. Entrepreneurs are not being well served in this Irish market. The wealth management is somewhat commoditized. It's not as sophisticated as it ought to be for very high net worth individuals. Let me try and make something here happen in Ireland. And I came to a decision of actually to go backwards to go forwards. And we reinvented Elkstone to go after an Irish client base, but retain as many of the international clients as possible. And that's what we've thankfully managed to do. So of about half the clients I had back then, I probably lost half because they weren't happy because they wanted really just me. And we've gone from maybe, we're 10 international clients. Now we have nearly 200 clients, and it's a real mix, primarily Irish, but we actually have, a very good balance between both the Irish and the international clients. And then when it comes to something like our venture, absolutely one of the reasons we have such an international portfolio is that second client that I was involved in. She was very conservative, but she had a great passion and interest in young entrepreneurs, and she compartmentalized her asset allocation. So while she was overall very, very conservatively positioned, she had a risk allocation for early stage venture. And I was the person who, vetted the founders, negotiated the term sheets, went onto the advisory boards. And that's where I got my real interest in venture and learned my, kind of trade.
That was literally my next question for you, because you went from a very PwC, EBS, a complete, not a complete change, but a very, very different change in mindset. And how did you switch your mindset from, a large corporate to running your own business and then going into like venture? That's a huge change.
I think it's I probably have different answers to that question. I mean, one thing I kind of say tongue in cheek is that I've done my career backwards, because and I go back to I did think I was good when I was in PwC, but I know now that I didn't know half what I should have known. So I know today I'd be a far better auditor and consultant today than
all the tricks.
I thought I was all the way back then. So I do think I've done my career. And again, if I go back to EBS and all the things I did in EBS, I would wonder, how did they ever let me in there to begin with? Because again, I know far more now, and I kind of feel now, God, they're the type of things I should have known when I was in EBS. So I do think I've done my career backwards in a way. But I think, to be fair to, I kind of views PwC as a very good, look, I was there for a long time. I was there for 18 years, but I think it's a super training ground, KPMG or PwC or Deloitte CNY for any young person, because I think you get so much exposure to so many different businesses, so many different cultures, so many different. So as an auditor, what an auditor sounds like and is, relatively, I guess, boring compared to some other careers, you get a fascinating insight into different businesses. And if you have a curious mind, you hoover up so much knowledge and so much learnings. And so that's certainly part of what I got out of PwC. And also at a young age, I was very lucky. I mean, I was a partner at 30. I was working on what were PwC's largest clients. I was primarily in banking. So, again, they're thought of differently today. But I got the opportunity of working with people like, the Morris Keanes and the Pat Malloys in Bank of Ireland, the Cormac McCarthy's in Ulster, Shawnee and Anglo. I mean, for a young person to be engaged and working with those people and in those boardrooms, that was a tremendous experience. So I was always interested in business as well. So I think, when I talk about venture in particular, I talk about the criteria that I'm interested in. And founders, the quality of the team is number one by a country mile. And I do think my experience in PwC is a huge asset in terms of being able to read people, judge people, figure out whether they're, have real substance or not. And I think that's a talent that has just evolved over time. And I do think my time in consulting and auditing was very pivotal to that. I also think, going back to the EBS experience, PwC is a partnership. So I always had that kind of partner mindset. You were one of 80 partners and you're working in a partnership. EBS was a mutual, so it was very much a cooperative type, mindset. And again, I see venture, the way I do venture, very much the same mode. Just the founders, and it's very much their business. But we're investing our money, our clients' money, so it's a collaborative partnership. And I think, again, that served Elkstone well in terms of our DNA. And we're very, very intentionally positioned as founder-friendly, in all the right ways. And I think that goes back to my own DNA in terms of, as I said, a partner, mentality from PwC, or a mutuality mindset, cooperative mindset from EBS. And then, through Roger and the experience of corporate finance, I have a capitalist mindset as well. So I'm able to pull the best out of all those different areas, I think. And I still, like everybody else, make lots of mistakes and get a lot of things wrong. But Yeah, I think versatility is a key strength that I think you need to have in venture, particularly if you're going to be a multi-sector focused venture fund or investor. I think it's very important to be able to be a generalist and at my level anyway.
We touched on that on Friday. Actually, you guys invest across the board, but when a deal comes to you, what's your kind of first analysis? What do you do first? What do you look at first? When a venture deal, we'll start with venture just to dig into that, because I know that's just something I'm passionate about.
It always depends on, first of all, where's it come from? And most of my deals I source from founders. So it's an introduction from a founder. Doesn't matter whether it's Dublin or whether it's Berlin or whether it's New York. It's a founder. So that's normally the first telling thing. What's the quality of the introduction?
So a founder referring you on to another founder?
Yeah, that's the highest pedigree in my mind. Clearly, particularly if it's a founder that I have, huge regard for. So, that's a very good starting point. But if I talk about, from a kind of analysis perspective, the first thing clearly we always look for would be the deck. And I always do look for it because I want to have a read of it before I meet anybody. It just gives me a flavour of what I'm looking at. It might be superficial, but it gives me a flavour. It also gives me a sense of how they're setting up their stall, how high quality is the pitch itself, how much care is being taken to tell the story, how easy is it just to get the big picture pitch or not? Is it complicated and messy, or is it, beautifully done, etc., etc. And then after that, it's down to, hearing from the founders themselves. And for me, that is, I probably can't exaggerate. It's probably at least 80% of what it's about, because, I'm very conscious. I'm an investor who backs people. So I'm investing in the people most of all. And I'm very conscious that venture and startups and entrepreneurship is very tough. So it's the quality of the people. It's their passion. It's my judgment of their substance. It's their personality around, do they have grit? I prefer to have founders rather than a single founder. I will invest in a single founder, but I prefer founders because it's a tough journey and you want them to have shoulders to lean on and support each other. But yeah, it's judging the founders. They're selling themselves. Sometimes people forget that. They're selling themselves more than they're selling the idea. And then I look at all the other things they expect me to look at. So what's the opportunity? How big's the addressable market? How much do they truly understand their own business model? What type of traction do they have? Is it a capital light model? Is it tech enabled? How excited am I about the opportunity, etc., etc.
I was going to say, when you get a deck, what kind of gets you kind of going, oh, there's something here. I look forward to seeing these guys. Is there one kind of little spark? Is it an area, or is it just a feeling, or what kind of gets you going on it?
I think it's definitely a feeling. I use lots of different analogies, but I would use the soccer analogy. I think there's certain players that are very technical. They're just, they know exactly what they're doing. They know why they're in a certain position at a certain time, and they, they're masters technically. And then there's some players who just, they just happen to be in the right place at the right time. They just seem to have that inherent ability to know where the ball's going and get there. And I think I'm more the latter in the context of venture. It's very hard for me to, distill it down to this is what it's about. It's an overall package, an overall feeling. And it's multifaceted. But as I said, by far for me, it's the judgment of the founders themselves. But I'd like to make the contrast with Warren Buffett that, he's often quoted, and I'll get the quote a bit wrong, but the gist of his quote is he'd rather invest in a super business with crap management because, the super business will it'll be okay. In venture, I think the other way around.
Yeah.
I'd rather invest in a super pair of founders and a challenged opportunity, because if I've got it right, they'll figure something out. And I'd rather have that approach. So I'm not saying I'm right and he's wrong, but I just think in different asset classes you have to take different approaches.
Yeah, they're different investments too. I think they're totally different things. Yeah, I was only reading that quote last week. I was reading his new notes. So that's the good things. What are the bad things? What are the things you look at and go, no, that's a massive red flag?
Again, presentation. So, if the deck is not great, that's just a black and white. For me, it's, they haven't taken the care, they haven't presented well, they don't get branding, they don't understand. So it's it can happen. I can then meet somebody and be wowed and converted, but it's rare. So I think, the quality of the deck and the care that's been taken. And, again, it's, I collect these phrases over time. I always get them somewhat wrong. But I think one that really lasted with me throughout my career is that one about, I wrote you a long story because I didn't have time to write the short one.
I thought you were going to say how you do anything is how you do everything. That's a new one on me. I'm going to take that one.
But it's so true when it comes to, I use it in my own business all the time, and it's so true when it comes to a venture deck as well.
Yeah.
You have to take the time to really, really nail it, to really distill it down. And when you do it, the quality comes through. When you don't do it, it's so transparent. So that's one watch out. And then second watch out is, and unfortunately it happens, and it happens at all stages. It's not just the young entrepreneur or prospective entrepreneur. People come in and they come in to tell their story, and they actually don't have the finger on their own pulse. They don't understand their own business. They don't know their numbers. They struggle. And that's always a knockout for me, unfortunately, because it just it's a tough business, and the last thing you want to be doing is investing in people who, again, haven't put in the work and haven't put in the hard yards to truly have the finger on the pulse of their own business. And if they can't explain their own business model, then how can you expect them to be good investments?
And you'd imagine if they got as far as getting in front of someone like you, that they probably should have their stuff together at this stage, you'd imagine. So if they've got that far and they still don't have it, then they're in trouble. Yeah.
So that's, look at it does happen, unfortunately. So, and we are good at sieving, but even then, they're probably they're my major watch outs. I go back to, they're selling themselves and they're selling themselves all the time. And again, I remind those founders we do ultimately invest in and we go on the journey with, I remind them that all the time as they go through the different stages. They're always selling themselves. So, from the word go, when I'm engaging with somebody, we're judging them. We're judging how they handle questions. We're judging how they handle the email traffic. We're judging how they handle the negotiations around the term sheet. We're judging them. And it's all part of the process. And some people, I think, just turn up and think it's the performance on the day that they're actually walking you through a deck, and it's not. It's that's the entry point, but it's only the entry point.
So you're looking for consistency rather than one good performance.
Yeah, and depth. Consistency and depth. Because we all know it ourselves. People can put on a show for 30 minutes. People can, practically everybody can talk a good game when they really, put the effort in. But it's the consistency and it's the underlying quality being there all the time.
So take us through a venture deal. When it comes in front of you, do the pitch, you like them, it's going pretty good. What happens next?
Well, typically we're very, very keen to let people down very quickly. Because we're conscious it's tough. We're conscious you have to kiss a lot of frogs behind you before you find that prince. So if we're going to be one of the frogs, we like to let you know very quickly. And I coach my people very, very hard that, look, as much as we have to ask the tough questions and as much as we have to put people through their paces, to have great respect for the people who are in front of us, because this is everything for them. They're putting their life and soul into this. So, it's a balance to get right. But genuinely, we try and let people down very quickly to give them as much of their time back so they're not wasting energy on us and they need to move on. But look, if we if we've liked the deck, we've had a meeting, the meeting's gone well, the next stage would be into interrogating the model. And we've become increasingly data-driven in over the years, because, I've learned through mistakes that, there's a lot of clues in the, people it's only a spreadsheet, and, clearly, we all know it's not going to work out like the spreadsheet, but there's so many clues in the spreadsheet in terms of the quality of the founders, the quality of the joined up thinking, the business model, how things link together, what doesn't connect, what's out of sync. So I encourage my team to spend a lot of time on the business model and on the financial model in particular to understand the business model.
Okay.
And that's clearly very granular and somewhat contradictory with my characterization of being the, just the natural kind of soccer player as distinct to the analytical one, but the two do come together. And I think that allows us then to have another go or two with the founders to probe harder, better assess our understanding, make sure we understand what we're looking at. But through that process, we're getting a better sense as to whether, the first round are probably, I guess it's maybe a little bit like a boxing match. Round one, can be you're just sizing each other up. You're getting a flavour for what you're up against.
How does he move? Yeah.
Round two and round three, depending on how long you're going to be going, you're beginning to. There's a bit of blood and there's a bit of bruising going on, but you're learning much more. So we go through that process, and ultimately then we make a decision. I mean, again, early stage venture, which is what we do. Ultimately, it is, in my view, it's a judgment call. And you can't analyze it to death. So while we do quite a bit of, analysis, we do it in a very short period of time. So, we can open and close a deal. If I exaggerate a little bit, and we've definitely done this, we can open and close a deal in 4 weeks. Wow. But, we're probably opening and closing a deal on average, certainly within a 2 to 3 month period on average. And then there are some that we follow that we say no to because we're just not there, but we're intrigued enough to say, no, we do actually want to stay in touch, and we mean it when we say we want to stay in touch, and we follow.
Don't call us, we'll call you.
Yeah. And but we do. We're and we haven't had many, but we've had a couple that have come back and been ready for us at a later date, and we've invested.
Okay.
And so again, that has served us well when we've done that.
So you'll see what they do, see what their next move is, see how the market develops, how they hone their thinking maybe. Yeah.
Did they deliver on what they say they would deliver? If not, why not? And so forth. Again, it just gives you much better context. So, it's more art than science. It's more art than science.
When you say early stage venture, just for anyone that's not familiar, what does that mean?
Well, for us, again, for those who are familiar with the lingo, I would say we do anything from a piece of paper, idea on a piece of paper, through to, well, in the Irish market, Series A. So we would do a Series A. In the international market, we've done Series B, and we've even done a Series C. But for those who aren't familiar with the language, our sweet spot really would be, I would say, a business that has just become revenue generating, or is within the first year or so of revenue generation. So from an idea right up to that type of stage,
right,
is what I mean by early stage.
Mm-hmm.
And again, depending on the sector, it can mean different things. But as a broad brush, pre-revenue or early revenue generating days is what I would consider to be early stage.
And I think for anyone listening who is familiar, and a lot of people are, but aren't, so we like to kind of keep it kind of broad for people. For you invest, we talked earlier on Friday, and you do your deals, you do quite a lot of deals, and you do them across a broad range of spectrums. Why is that? Why are you not niche in one specific sector, like fintech or pharma?
Well, there's a few reasons. One is it's certainly by choice. So we're choosing to be a multi-sector firm and take that approach. 2 or 3 really good reasons for it. One is that, and this is not in any particular order, but to kind of justify it, Globally, the stats are very clear. Multi-sector VCs are the best performers, and that's proven over a long period of time, rather than being niche focused. That's not to say that you can have clearly top quartile type firms in a niche doing really, really well, but as a generalization, multi-sector VCs outperform niche operators. Second reason goes back to the ethos of Elkstone itself. We're a firm looking after entrepreneurs. We're not a firm looking after only fintech entrepreneurs, or we're not a firm only looking after med tech entrepreneurs, or only looking after tech entrepreneurs. So we've a multitude of entrepreneurs that we're looking after. They have lots of different interests. So we're very conscious of their know-how, their knowledge, their insights, their network, and therefore we want to look after our clients in that wider context. And then, look, lastly, has just been, what I might call pragmatic about it. We're sitting in Ireland, and if we were going to be solely focused on fintech or medtech, I think the capacity for us to grow a really interesting VC business would be somewhat constrained. I think we have to be opportunistic, and we have to be prepared to do lots of different things. And we're generalists. We're made up of, in Elkstone, we've people who have, private equity backgrounds, real estate background, accounting, law type backgrounds, business backgrounds. So we're a group of people who've got multidisciplinary skills. And again, I think that serves us well in terms of being generalists and multi-sector.
You talked quite a bit. I've read previous interviews yourself. You talk a lot about kind of Ireland Inc. and kind of the challenges that Ireland faces. You've kind of touched on it there about investment in Ireland, especially in terms of tax relief and things like that. I know you guys have just launched a brand new fund. Do you want to talk a little bit on that?
Yeah, look, I think, I didn't grow up in venture, and I didn't grow up in the startup system. So, I've been personally doing venture investing now for 7 years. We've had our club, the Elkstone Club's been up and running for 3 years now. And, I've learned a lot over the last period. And my assessment is that our ecosystem is not where it needs to be. And that's from a whole host of different angles. I think, venture is a very tough game. Money is incredibly important in terms of being able to support, scaling up aggressively. The really top players, the Andreessens, Sequoias and so forth, they aren't operating here. So I think there's a need for Ireland Inc. to really, try and accommodate and nurture VCs. And I think Elkstone in its own way, family offices are very important as part of the global ecosystem. And again, as we touched on earlier, Ireland doesn't have a history of family offices. So family offices are great at network, they're great at introductions, they're great at helping globally. So I really think that Ireland Inc. needs to be supporting VCs by accommodating private money being invested in VC funds to support the Irish early stage venture system through the likes of EIS Relief. EIS Relief has worked well for individual investments into an individual company. But I think EIS needs to be broadened so that it accommodates private individuals investing in a fund, so long as that fund itself is then investing in early stage startups. And I think that will be better for the Irish ecosystem because it'll help VCs here grow stronger and network better. And I think it's also better for the investor because rather than having a single punt on a single early stage company, they're being properly protected through a diversified approach. So I just think we need to be smarter about how we use government policy to get the right type of kindling and growth, which I think would then, serve us all very, very well.
Is that due to the lack of ecosystem? Is that just because it's so early, or do we need to look to, everyone talks about the US and the UK. Do we need to look over there and go, look what they've done and bring it over here? I
think there's a bit of that. I think there's no doubt that, look, Ireland's done well in lots of pockets and lots of things to be proud of. But I think our early stage ecosystem needs greater support. And the US are incredibly strong, but people don't understand that one of the reasons they're very strong is the US back in the 70s made very significant tax policy changes to accommodate private individuals investing in early stage venture. And it was from that early start that they built up what they have today. That's the type of thing we need to be doing. There isn't this culture in Ireland of people investing their hard-earned money in early stage venture and risking it. And it is high risk. But how can you accommodate that. You can accommodate by giving the right type of tax breaks, and you can accommodate it by making sure the right investment vehicles are there to support that in as sensible a kind of portfolio, risk-adjusted way as possible. And I think it's then over time, you get your startup success, you get your VC successes, and it snowballs. And that's what's happened in other ecosystems. It hasn't really happened here. And I think it hasn't happened here because our legislation is still somewhat archaic and hasn't been tailor-made. It's not product market fit.
That's a nice analogy. So we haven't talked about why we're both sitting at home 4:30 on a Monday. I don't think I'd grab you, a man as busy as yourself.
On a bank holiday
as well. Don't think I'd get yourself. I don't think I get such an hour, such valuable time. Okay, we're all aware of what's going on at the minute. What's been your experience the last two months? So it's, what are we now? June already. Wow. Okay, so since mid-March, what's been your experience?
It's been mixed. I think it's still early days. I think the initial, certainly late March was very much from our perspective, sticking with the VC side again, the venture side again, very much was trying to figure out, who's in trouble, who needs help, who's well placed, where can we make a difference? Because again, you have to be honest, in some cases we're not able to, make that material difference. So I think certainly the initial period, probably for the first month, was very much, trying to engage and understand what's going on and, counselling, mentoring in a positive way, cautioning people to be cautious, to slow down some of the investments, slow down the acquisition of talent, look hard at what cost savings could be made. And we were saying that to every portfolio company, regardless of whether they were in the tail of being the fortunate ones where this was going to be a tailwind, or whether they were the ones who were most vulnerable, because we felt, look, slow down, buy a little bit of time, let's see how things are progressing. And then you can always put your foot on the accelerator again. But let's make sure you give yourselves options. And that's something that's very important in early stage. It's very important all the time, but particularly important in early stage venture. For founders to be mindful, always make sure you've got options. Always try and keep, some cards. It's very, very important. So that was certainly the first month. I think, again, we've been going back to our pipeline. If we typically do a deal over a 2-month period on average, we would have had deals that were live that we were seeing through. And we've also started doing some new deals as well. So we've been probably unusually busy in the sense that we've done 4 or 5 deals over this period. Some of those just happen to have been coming through and some have got accelerated. And again, we're very pleased to have been able to do that. I'm very pleased that our clients, we were concerned that our clients may, pull back and wait to see. But thankfully that hasn't happened. So we've been able to keep investing. But I'd be still very clear it's early days. And, I think the support levels that are here in Ireland, in my view, are, clearly government have acted as well as they've been able to so far. There's major constraints without a new government formed. There's going to be lots of changes needed. But I'm very clear in terms of a single Europe. We've portfolio companies in Germany and France and in UK, and the type of supports that are being made available in those countries are far different to what's being made available here. And I'd be very worried about, again, our ability to compete and our ability to tell a really positive story going forward in terms of how Dublin and Ireland as a whole, the regions, can compete in Europe if our government's not able to deliver the same type of support that the UK government or the German government or the French government have. So I am genuinely concerned about that. And it's back to my, honest assessment that I think our venture ecosystem, in terms of, whether it's, government apparatus or whether it's the VC players themselves, needs to expand and grow a bit more to give us the wherewithal to compete internationally.
And I think it's never been more important now as people become more willing to work anywhere. You're not going to be tied to Ireland if you're going to be remote anyway. Well, look, we'll just set up somewhere else. We'll go to Estonia. We'll become e-citizens. We'll just go over there. That's it. Well,
look, I'm kind of mixed views about this. I've speak at a couple of things every now and again. I was speaking of something in Trinity a couple of months ago, and I remember being asked one question, which was, well, why shouldn't I go to the UK and set up my business there? And they were talking about the entrepreneurial tax reliefs and so forth. And, I made a strong rebuttal about, well, Ireland and the advantages we have and blah, 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 etc. And I believe that. But, honestly, if when push comes to shove, Ireland Inc. and our government can't deliver the type of support that's needed in a difficult scenario, that's a big driver to say, do you know what, actually, if you're taking a risk adjusted approach, maybe you should be investing or starting your startup elsewhere. So some people like myself, no matter what, will just want to build out of Ireland. Let's Get Checked. Peter Foley and Ronan are super examples of that. They're one of the companies we invested in very early, doing incredibly well. They fought, when it came to the Series A, they fought tooth and nail to keep the company here in Ireland. They did not want to have it brought to America. The investors for Series A wanted to bring the company lock, stock and barrel to the US. And the guys fought tooth and nail to keep it here. And they won out. And they won out because they're super founders and everybody could see that, look, it was with them or without them. And therefore it was staying in Ireland. So I think some people will just always want to be passionate and build here and be proud of here, but they deserve more support.
They're an unbelievable story. I wasn't sure if you were going to be able to talk about them. They are an unbelievable story. It's great to see. And there has been positives in the last couple of weeks. There's been people closing absolutely massive rounds like the lads. That's incredible.
Yeah, no, it's amazing. And that's what when I talk about the ecosystem here, that's what we need more and more of. We need people looking at the likes of Peter and Ronan and going, wow, that's it. And it is amazing what they've done. And again, I have to be careful with them that, look, it's still a journey. We've a good bit to go yet, but I'm sure the guys won't mind me saying it. I mean, there was a time where Elkstone and Peter, we literally had to deliver, personally delivered the cash to pay the wages, and to see, and that's where I get the satisfaction from, to see a company now that just raised $71 million with the type of quality shareholders they have. Is just like Illumina, Deerfield, Lerink, HLM. I mean, these are the pedigree of pedigree in terms of US investors, healthcare investors, and they're in an Irish company that didn't exist 4 years ago. And they're the great stories that we need more and more of, that will really act as an inspiration for not just, young entrepreneurs, but act as an inspiration for our government to see that this is not throwing away taxpayer money. This is, if you support the ecosystem, you're going to get paid back 10 times over.
Yeah. I think it's so important that what you touched on there, to see it. You need to see it. People need to see things happening in front of them. So many of the entrepreneurs I talk to, their dad or their mum or their sister or their cousin or their uncle is an entrepreneur, and they saw what they do. And just by seeing them in action going, yeah, I reckon I could do that. Young startups need to see people like Let's Get Checked here in Ireland and going, yeah, they raised 70 million. Well, I can build a business to that scale in Ireland. I don't need to, I can think a little bit bigger maybe.
Yeah. And, look, the reality is, to get that type of money, you're going to have to get money from abroad, and you're going to have to be, clearly abroad as well. But Let's Get Checked is still headquartered in Ireland. It's going to stay headquartered in Ireland. They're going to be near 400 employees by the end of this year. I mean, It is just phenomenal. And the guys are only getting going. They're only getting going. So I hope I don't jinx them now, but they're and they've just got their FDA approval, the first globally for end-to-end self-checking at home COVID testing.
They got
and
that.
Again,
wow, okay.
That's FDA approved. And again, that's just going to open up phenomenal doors for them. And that's an Irish company.
That's incredible.
An Irish company that didn't exist, as I said, say 4 years ago. Never good at dates. Maybe it's 3.5 years ago. Maybe it's 4.5 years ago.
Not long is the answer.
Not that long ago.
That's incredible. So what else? What else are you looking ahead in the next 6 months and going, either, I see an opportunity there, or this is what the areas I think there's going to be growth in?
because we're opportunistic, we're not, and I'm an investor myself in quite a few VCs globally, and I'm close to them. I understand different models and so forth. And some are very purist. They're very focused on, bottom-up research in terms of figuring out where's the next trend. Mm-hmm. Where do I want to be investing? What niche do I want to be investing? And then they go out searching for those companies. And they know the metrics and they go searching for them. And I am an investor in some VCs who operate like that. I'm back to my bias from an Irish perspective, and investing in Irish VCs is, I'm just out there trying to understand everything that's moving. And if I'm able to keep my finger on the pulse and understand what's moving, I'm hoping I'm going to be able to identify our fair share of the ones that are really worth backing. And I've become, as I've, again, it's not that I've been doing this for that long. I've personally been doing it for 7 years now, but I'm now at the stage, thankfully, where I've had some successes, and I'm more selective of ones where I think they can have a real impact. So that's a personal bias of mine. So give you some good examples, and it's not just Irish ones as well, but Let's Get Checked would have appealed to me because of its impact it could have, and it's clearly bearing fruit. A UK business that we've invested in is called The Meatless Farm. It's in the meat substitute space. Again, big impact type space. So I'm looking for really smart and talented, ambitious founders. I'm looking for businesses that are going to have an impact. I'm looking for ambition, and I'm looking ideally for businesses, for whatever reason, they're not getting the interest they should be getting. And that's probably Elkstone's forte. We've backed time and time again, particularly Irish businesses who couldn't find love anywhere. We were the ones who, for whatever reason, took the chance. And that goes back to, I do genuinely think we'll take risks that perhaps others won't take. And that thankfully for us has paid off to date. And maybe we've just been lucky, but that has definitely paid off for us. So I'm not going out with a particular focus. I'm staying opportunistic. That's what we're best at doing, being opportunistic. And then relying on our network. I call it, I like to think I'll have a trademark on it one day, but I like calling it network compounding. That's what Elkstone do. We're network compounders. So we do that with our clients. Our clients compound through word of mouth. Our clients bring us other opportunities. Our portfolio that we've invested in, we've over 50 investments now, Irish and international. They compound. All those founders, we're close to it. They share deal opportunity with us. So just staying alert to opportunity and being agile, and not being closed-minded, and knowing where we can make a difference. I like doing that. I like being, if everybody's trying to get into a deal, then what are we going to bring? Not a lot extra, I think, in truth. But for the ones that I said are unloved, or the ones that just can't get traction despite how brilliant everybody thinks they could be, we can make a real difference. And they're the ones I really like to get involved in.
Was there any investments you kind of looked at and went, not really sure, don't really think there's anything there, and then subsequently they just exploded? Or is there investments you saw a few years ago and went, not sure it has it, and subsequently went on to big things?
We've been very lucky in the sense that we've done with the club. So if I talk about the club have done nearly 30 deals now in 3 years. So we're averaging about 9 to 10 deals a year. And that's Irish and international. And we've been jilted once. And that was hugely disappointing for me when it happened, because we'd made the commitment, we'd got to the altar, and then literally a couple of days before closing, that particular company turned around and said they were taking a different deal elsewhere. And I felt incredibly let down. That's a business that's doing very, very well. And it bothers me. And I don't mean that in a mean way.
No, I know what you mean.
I'm delighted they're doing very well.
Yeah,
but it bothers me that because I look back and think, what did I do wrong? Because I kind of, I'm a bit like that. It's I don't believe in this Demonos. I believe in, we got something wrong. So that one bothers me because the club loved it. We had great interest in it. People still raise it with me today that, they were going to put money in that, but I didn't deliver. And we hate not delivering for our clients. So there are ones that have got away, So I definitely have that experience of ones that got away. But it's rare.
That's not a bad ratio, though, in all those 20 years. Maybe I'm conscious of keeping you now. We're nearly at the hour. But just explain briefly what the club is, because I think a lot of people won't know about it.
So look, as I said, I've been doing venture investing myself for 7 years. So roll back 3 years ago. So I've been doing it for 4 years. 3 years ago, I was doing well. I had a nice international portfolio primarily, but I was writing relatively small checks. I was very conscious that, there was an opportunity to, no one in Ireland, I was seeing what was happening internationally, but I was very conscious nobody in Ireland seemed to be looking after individuals and bringing them into venture deals. So I had the idea of, look, why don't I allow clients, Elkstone clients, co-invest beside me? So if I'm putting money into a particular deal, I'll give clients an opportunity to invest beside me. And I thought of that as a positive for 2 or 3 different reasons. One, I felt that by having bigger checks, it was going to help me get into even better deals. Secondly, I felt it was going to be helpful for Elkstone as a client acquisition strategy, because venture and the opportunity to invest in international deals would attract people into Elkstone, and then we could bring them across into real estate or into the private office and so forth. And I also started it because I knew I couldn't do a fund back then. I didn't have a track record. I certainly didn't have a long track record. And it was going to be very hard to attract the type of money you'd need to make a fund actually work. And who's Alan Merriman or who's Elkstone, etc. So I purposely started with a very small group, a hand-picked group of clients who I knew venture, knew what I'd been doing. And I started with, I can't remember, but certainly, no more than 10, somewhere, I don't know, I really don't remember, less than 10 anyway. And the idea was make it very easy for them. I was going to be making the investment anyway. I was putting in my own money, my own risk. They had the free option of whether they wanted to, participate with me or not. No obligation, no management fee. We would charge a carry, but it was a nice, easy way to say, look, you'll get a free look. And if you like it, more than happy for you to come in with me. And if you don't like it, no bother. The only thing I'll ask you is, look, if I'm going to keep showing you deals, don't waste my time. Yeah. If I show you 10 deals over the next year, I'd like to think there's a couple that you'll end up doing. Because if they're all bad, there's something wrong. We're wasting each other's time. Yeah. So I had that kind of gentleman's agreement with everybody. Day one, had the 10 clients or so do it. And it just evolved from there, because what happened was, it really gathered momentum. So, it's now at the stage where we genuinely, we're at a level where, you don't get into this club unless it is a special club. You can't just turn up and, I want in.
I have 20 euros.
clients have to, clients ask us kindly, can they introduce somebody? Would we mind if they introduce somebody?
Yeah.
And it's not that the club, they don't know each other. There's privacy, and we have events and they can come if they wish, and that's their own business. But it is very confidential, very private, but we are very selective. We want people who truly understand venture. It's a high risk space. So we want them to understand it's a portfolio approach. We want them to be able to, kick the tires. We want them to be sensible about what money they're allocating. And ideally, we're looking for, we like entrepreneurs and we like tech people because they know what they're getting into. Yeah. So we've been lucky. We've built up a very high pedigree club. They're all, and I don't mean they're all smarter than I am because I'm the generalist, right? So, but we learn a huge amount by, when we bring a deal out, we keep our due diligence going because the questioning we get back and the challenge we get back enriches our own understanding. And again, that's, serves us very well as we go on the journey with these different portfolio companies. So that's the club. We're hoping to bring out a fund, and we're very close to doing it. We've some substantial money lined up to do it. We're hoping to combine it with EIS relief, and we're waiting on revenue approval, which unfortunately is dependent on a piece of legislation changing. So we're going to work very hard to see if we can get the new government to make a little tweak in the legislation, which is to allow, funds such as what Elkstone will be to get access to the EIS relief. And we think if we can do that, it'll serve, the ecosystem here very well. It'll serve our clients very well in terms of giving them good, appropriate tax relief. And we'll be able to do it in a very diversified way, which is the way we think venture investing should go. So that's the hope. And look, badly needed. We thought there was a crying need for it late last year and early this year. Now, against the COVID background, the more private money we can get to work in early stage venture, the better all round.
Absolutely, especially when there's hopefully going to be a spike in new ventures been started now as people kind of look for new options. Just before we go, is there an area you love investing in that other people think you're crazy?
I wouldn't say, I can't narrow it down to an area.
Okay.
What I will say is, and it is ironic, if I pick out, if you look at our portfolio, people look at our portfolio, and it's hard for me because I'm biased and everything else, but people, and I, sometimes clearly you like to hear the positives you hear, but I think when people look at our portfolio, they do see it as a very high quality portfolio, and both locally and internationally. And I would pick out, let me put it this way. I get all the time, I still get it today, even though I'm very disciplined about it. When we release a deal, I still have clients who ring me and ask me, is this the one, Alan?
Is this the one?
And
they're all the one.
Exactly. And I tell them all, and I'm true on it, right? They're all my babies, right?
Yeah.
You love all your kids, right? So I'm putting my money in every single deal we do, right?
Okay.
I'm not going to bring a deal to our clients that I don't love, that I genuinely don't believe in, right? So I find it very, very difficult to differentiate between them. But having said that, I mean, look, clearly you'll always have your natural kind of, gut instinct in terms of, if you, and I do it. I've shared with nobody, but I have my league table of who I fancy from one all the way down. And I keep it live. But of the ones that people would consider to be our stars, the Irish ones, so I won't talk about the international ones because, they mean less to your audience. But I'll just pick out, Let's Get Checked, Flip Dish, Soapbox. If I pick those, I'll pick another one, right? Containers. So there's 4. Now there are 4 Irish companies. Those 4 are real stars. Those 4 are doing incredibly well, and clearly I hope, if I don't jinx them, they'll continue to do incredibly well. Elkstone's the only party who would invest in those at the time we invested.
Wow.
And that gives me, we're going to get lots of things wrong, but that gives me, there's something about how we do things that we're, maybe it's a fluke, right? But it's 4.
That's the numbers.
4,
the numbers stack up, and they're big. Anyone listening will know those. I mean, even Soapbox have just had a massive bit of news there in the last couple of weeks. So yeah, anyone that knows will know those stories. That they're big.
And then
successes.
I remind myself and I remind everybody else, and I try and remind our clients and supporters too, that VC is a very interesting game, and that it's the only business. And this is, if you take the very best in the world, Sequoia and Drayson, you get more wrong than you get right. So if you look at their portfolios, they will lose more individually in individual investments than they get winners. It's this power law distribution. So you have to remind yourself and stay humble that, you're going to get things wrong, but it's about making sure you're good at getting winners. And we're still, I said to you on Friday, we're still in short pants, right? So I still think 7 years for me and 3 years for the club. It's still early days, but there's not just for Elkstone, but for Ireland. Those 4 companies are 4 real prospects for, real growth and something we be really proud of. And they're only 4. When I say they're only 4, there's lots of others in their portfolio, but there's lots in Atlantic Bridge's portfolio, and there's lots in Frontline's portfolio. There's lots of Irish examples. I just wish there was a multitude more. And I just wish there was more Irish money, more private client money, more international VCs here in Dublin supporting Irish companies really scale. Because I think we have the talent and we have the ambition and we have the connections to really, really do very well. But what we're missing is the capital. And that's probably my, in terms of this conversation and on my particular angle, Gary, that's probably my kind of, cry for, hopefully somebody's listening in influential circles who gets it, that this is not about throwing away taxpayer money. This is about investing taxpayer money that will pay back in just multitudes if it's done in the right way.
Okay. And looking kind of ahead, just two last questions for you wrap up. The last question is to recommend a book, so you can just think about that for the next couple of minutes. And looking ahead to the next 6 to 12 months, get out your crystal ball and tell me what's going to happen. But what are you expecting, in the next, say, 3 to 6 months and then 6 to 12 months?
I think you mean generally or from an Elkstone perspective?
Both. I mean, one leads into the other. So generally, and then how will that lead in for Elkstone?
So, look, my personality is a little bit contradictory. I'm an optimist, right? And again, you can't be in VC and you can't do my type of job unless you're an optimist. But I think I'm an optimist who starts with a kind of a negative mindset. So I start with, hey, it's going to be a tough time. This is going to be a valley, and I'm going to have to get through it. And we'll get through it, and we'll come out of it. And that just helps me, soldier through it. So I have the mindset of preparing for the worst.
Yeah.
And hoping it doesn't get as bad as that. But I also have the mindset, and this definitely goes back to Elkstone and the wider Elkstone, we're opportunists. And in crises and stress times, lots of opportunities come. So I go back to one of the things I said earlier on, if I'm not confusing it too much, is that I believe in call options. It's very important to have optionality all the time. So I see it in portfolio companies. I see it in Elkstone's business. I see it in clients individually and in their businesses. You need to be very conscious that there's always options. And you've always got to be playing for time to increase more options. So what do I see over the next 3 to 6 month period and beyond? I see lots of options. I see keep things going. I see be careful with the money that you're deploying so that don't be overly generous in different pockets so that you have more to share all around. Don't stop investing. Again, the academic and the facts are very, very clear. The best returns come from the vintages in the most stressed time. So again, our message to our clients would be this is the very time to be seeking out opportunities and putting money to work. You'll get rewarded very strongly. You'll get into better companies than you might otherwise get into. Those companies be more resilient. They'd be much more scrappy in how they get by with less resource, blah, 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 etc. So it's that mixed message. It's going to be tough. There are companies who are definitely going to fail because the support just unfortunately won't be there for them. Equally, there will be new opportunities that will deserve backing and should get backing, and they're going to reward one handsomely. And then as a VC, it's about unfortunately, it's about capital allocation. You've only a certain amount of money and you have to judge where you're going to share it. And an environment like this forces you to be more clinical about where that money goes, which is tough, but ultimately probably a good discipline.
Absolutely. I think the entrepreneurs that come out of this will be incredibly resilient. If they can build now and build something sustainable in this time, they can, when the good times come, they'll get a 10x. So every week we give away a book. All they have to do is just tag Elkstone and tag myself on social media or anywhere they like and just share your episodes. So what book has had an impact on you?
I'm a big reader of probably, venture type books and self-help type books, which I always just enjoy. My wife's always given out to me, would you ever relax and read a fiction book or whatever? But I just enjoy those type of books. And we give a book out every year to our clients.
I did not know this. Oh, I'm interested now.
So a book we gave away not this year, but the previous year. And I just have it written down here. Venture Capitalists at Work. Venture Capitalists at Work. And it's by an author called Tarang Shah, S-H-A-H. And it's a fascinating book in the sense that it's giving a chapter on lots and lots of different VCs and sharing their experiences in investing in a range of different companies, including ones that didn't go well and ones that ended up being stars. So it's a great for the entrepreneurs listening to your show and for, want to be entrepreneurs. It's a great insight into the minds of a whole range of very successful VCs, far more successful than I'll ever be. But it's very, very, very insightful, and certainly a book I enjoyed. And it's a book you can dip in and out of. You don't have to read it from cover to cover. But it's certainly a book I really enjoyed. So that's one I'd recommend that maybe people haven't heard of.
Brilliant. No, it hasn't been recommended. I love that you give away a book to clients every year. That's a cool idea. That's brilliant. I'm definitely going to pick that out. To be honest, I started doing this just for myself. I wanted to get more book recommendations, so I thought it'd be a great way. And we're starting a book club as well.
Hopefully you'll enjoy it, Gary.
Oh, hopefully. So where can people learn more about either yourself and Elkstone?
Well, look, I think the easiest place is, we have a website, Elkstone Partners, and we're on LinkedIn as well. And look, if you're an entrepreneur and you think you've got something that's compelling and you think it's going to meet the mark, just reach out directly.
Great. Yeah, no, because I was so excited to get you on, because I've had so many entrepreneurs and they've told their story, and I was very, very excited to get someone on from the other side and go, look, this is what we look at, this is how we think, this is our deal flow. I think it's just very good for people who, even if they're at an early stage, to kind of start thinking ahead and going, right, what way are we doing it? How are we approaching this? So thank you so much for taking time out of your day. I really appreciate it.
Not at all. Look, great to have the opportunity, and keep doing the great work, Gary. It's needed.
Absolutely, I think so. I think that the more people, there's hundreds of entrepreneurs in Ireland, and I think the more time they get to kind of tell their story, the better it'll all become.
Yeah, and building up that community, because it's
exactly.
As sexy as entrepreneurs are, and the business of entrepreneurs, it's a tough journey as well. So I think what you're doing is genuinely, look, it's another link, which I think is very important.
I think so. And what you said there about compounding, your network compounding, that just kind of spoke a lot to me, because a large part of the reason for starting the podcast was to build my network, build that on top of each other. I've done countless introductions between episode guest and episode guest. Oh, I listened to that episode. Can I chat? And it just makes me so. I did one today. It makes me so happy just to be able to connect the dots, because it often just takes that one little conversation going, we have this massive problem. Oh, he had that 6 months ago. There you go. Done.
Look, I'll give you, again, I don't want to give you a very last example, but I'm going to add two things together. So another phrase I've lived with for a long time is keep passing the ball. Keep passing the ball. And one day they'll pass the ball back to you, right? So and that's just to reinforce the network compounding. But I'll give you a really, really lovely example, right? So we have... during the week, through the family office, we had a client who, for very particular need for COVID testing. And we had Ronan from Let's Get Checked, one of the two founders, personally dropped out to one of our clients.
Wow.
The COVID test. Now, for us, that's the magic in the making. Unconnected, they don't know each other from Adam. But you're able to connect people, you're able to make things happen, you're able to get favors done, and it compounds. It comes back in multitudes. And it's about doing that not just in our own backyard, it's about doing that globally. And that's my message about family offices and us being a different player. And it's about VCs here and linked internationally. The more we're connected as a country, as Ireland Inc., the more we're connected through family offices and investors and entrepreneurs and VCs, the more we can make happen here, the more we can make the magic happen here. And that's the message that I'm really trying to get out there.
It's brilliant. It's a powerful message. Brilliant. Listen, Alan, thank you so much.
All right. Take care.
Talk to you soon. Bye-bye.
Bye.
And that was episode 55 of The Entrepreneur Experiment. I hope you enjoyed it. If you want to win the book that Alan mentioned, simply share this episode on any social media channel you like, but be sure to tag us. Be sure to tag me, Mr. Gary Fox, and Elkstone. I will see you next Thursday at 6 a.m. Don't forget, go to my website, register for the book club, and get reading for the month of June. I'll see you next Thursday.